How you doing? I'm Big D. Now, before we begin, I want to ask you something important. If 1 ounce of silver suddenly becomes worth more than an entire barrel of crude oil, what does that tell you about the world's economy and the financial system you depend on? Now, because what just happened in the silver market is something so rare that it has only occurred only one other time since the end of World War II. Not twice in a decade, not every few years, not once in more than 8 decades of more of a modern financial history. Yet almost nobody on mainstream media is talking about it, or should I say, deep state media. Now, no one's explaining why this actually matters. What happens the last time it appeared, and the reason is simple. If they walked viewers through the historical comparison with complete honesty, it would create a level of urgency around precious metal ownership that their banking and brokerage advertisers simply cannot afford to encourage. Right now, 1 ounce of silver is worth more than 1 barrel of crude. Now that's just crazy. Now, on a monthly average basis, the price of a single troy ounce of silver has risen above the price of a barrel of crude. Now, this has only happened twice since the end of World War II. The first time was during the global chaos surrounding the Iranian hostage crisis, the Soviet invasion of Afghanistan, and the famous attempt by the Hunt brothers to corner the world's silver market. That moment became one of the most explosive and chaotic periods in the history of precious metals. Today, that signal has appeared again. Silver is trading close to $90 per ounce, while oil suddenly plunges from $120 down to 100 to $81 in less than 2 days. The oil market reacted immediately. Price dropped sharply as traders believed the conflict might be cooling down. But silver did something very different. Instead of falling alongside oil, silver held its ground and even rallied up around 5% during the same period that crude prices were collapsing. That divergence between two of the most important commodities on the planet to tell us something extremely important about the current condition of the global markets. When oil and silver move in opposite directions like this, it usually signals the psychology of investors is shifting in a profound way. Oil represents energy, industrial demand, transportation, manufacturing, the daily functioning of modern civilization. When oil is strong relative to precious metals, it usually means economic growth is healthy and markets are focused on production consumption. Silver, however, has always carried a dual identity. It is both an industrial metal and a monetary metal. When silver begins to outperform oil, it often signals that investors are becoming less concerned about economic expansion and far more concerned about the protecting wealth. It's in simple terms, it means that the market is prioritizing monetary preservation over industrial consumption. Capital begins to move away from the productive asset and towards protective assets. And when that shift begins, it usually reflects a growing belief that the current used to price, those commodities may lose value in the future. That is exactly what happened during the previous episode when silver surpassed oil many decades ago. At that time, inflation was running out of control, confidence in monetary policy was collapsing, geopolitical tensions were escalating across multiple regions. Today, the backdrop appears even more extreme. United States has carried national debt exceeding 41 trillion compared to less than 1 trillion during the earlier period. Government deficits represent a massive portion of the economy, while policymakers face an impossible dilemma between controlling inflation and avoiding recession. At the same time, the geopolitical landscape has become increasingly unstable. Military tensions are rising, alliances are shifting, and the global monetary order that dominated the last 80 years appears to be fracturing. The situation involving Iran has become a key catalyst for recent volatility. Military operations involving airstrikes and Navy force targeting Iran military infrastructures during a week of intense escalation. During that period, oil surged to around $120 a barrel, reaching a multi-year high. Gold climbed sharply. Silver surged as well. Markets reacted instantly to the rising geopolitical risks. Then, after the announcement that the military campaign might be nearing completion, markets attempted to return to normal. Oil collapsed quickly. Stocks recovered. The dollar stabilization temporarily stabilized. But beneath that surface reaction, something deeper is happening. One of the most powerful banks in the world recently warned its wealthy clients not to rely on what analysts have begun calling the taco trade. That phrase referred to a belief spreading along investors that political leaders may back down whenever financial markets experience turmoil. The idea suggests that if policies trigger economic disruption, they will eventually be reversed in order to stabilize markets. However, major financial institutions are cautioning that geopolitical conflicts cannot be controlled by a single political decision. Multiple actors are involved, each pursuing their own interests. Once tensions escalate, outcome becomes unpredictable. Analysts have emphasized that the current situation contains many possible paths, and not all of them can be managed by any one government. This uncertainty has led many geopolitical observers to warn about the potential long-term consequences. Countries that do not currently possess nuclear weapons may begin to consider their security strategies. If a nation observes another country being attacked while lacking nuclear deterrence, the lesson becomes obvious. Possessing such weapons may be viewed as the only reliable protection against external military intervention. That dynamic creates an environment where nuclear proliferation becomes more likely. Strategic alliances may shift. Rival powers could decide to support nuclear power programs in order to counterbalance existing global influences. If such a trend accelerated, and geopolitical instability could remain elevated for years rather than months. And even time geopolitical risks intensifies, investors typically respond the same way. They move capital towards assets that historically prove value during these uncertain periods. Precious metals have played the role for thousands of years. Gold and silver often become financial shock absorbers when the rest of the system struggles to process fear and uncertainty. Gold is already demonstrating extraordinary volatility. In the early weeks of this year alone, the metal has experienced an unprecedented number of daily price swings, exceeding $100 an ounce. Such movements were historically extreme rare, yet they have suddenly become frequent events. This type of price action is non-characteristic of a calm or stable market. It suggests that the global investors are rapidly reassessing the value of monetary assets in real time. Capital is searching for safety, while confidence in traditional financial structures appears increasingly fragile. When market begins repricing assets at this speed, is often indicates that something fundamentally inside the system is changing. Investors are not merely reacting to headlines. They're responding to structural pressures building beneath the surface of the global economy. And when those pressures intensifies, precious metals historically become the destination where uncertainty, fear, capital all converge. What makes the current situation even more remarkable is that the technical structure of the physical market is beginning to align with the fundamental and geopolitical forces already building beneath the surface. When you look at the price behavior closely, silver is not acting like a market that is exhausted its momentum. Instead, it is behaving like a market that is quietly gathering energy before another move higher. Now, after recent rallies that pushed silver towards the upper 80s, the price did not collapse the way overheated markets often do. Instead, it paused, stabilized, and began forming a tight consolidation pattern just below the $90 level. This type of price behavior is something experienced traders immediately recognize. When a market surges upwards and then holds, it gains instead of rapidly giving them back. It usually signals accumulation rather than distribution. Accumulation means buyers are continuing to step in a direction, minor dip, kind of a minor dip, absorbing supply while preparing for the next push higher. Distribution would look very different. In a distribution phase, prices spike quickly and then become falling as traders rush to lock in the profits. This is not what we are seeing in silver right now. Instead, the metal has been building a base while staying above several key technical indicators that institutional trading systems used to determine directional momentum. One of the most widely monitored indicators in the short-term trading is the 100-hour exponential moving average. Now, this level acts as a dynamic support line that many algorithmic systems rely on when identifying whether a market is trending upwards or downwards. Recently, silver moved decisively above that level, and has continued holding above it, which signals that short-term momentum has shifted in the favor of the bulls. When price action holds above that type of moving average, many trading algorithms interpret any pullback towards it as a buying opportunity rather than the beginning of a decline. As long as the metal remains above the zone, the overall bias tends to remain positive. What makes the current setup particularly interesting is that the consolidation is happening directly beneath the major psychological barriers. That barrier is the $90 level. Round numbers like 90 tend to attract enormous attention in financial markets. Traders remember them. Algorithms track them. Retail investors watch them closely. When a market approaches round numbers that carry physical, psychological weight, it often hesitates briefly before deciding whether to break through or reverse direction. If the price breaks through its strong momentum and high trading volume, it can trigger what traders call the cascading effect. Momentum traders enter new positions. Short sellers begin covering their positions to avoid losses. Algorithm detects the breakout and initiate automatic buy orders. The combined effect can cause price to accelerate rapidly. Silver appears to be positioning itself exactly at this type of threshold. Every day that the metal continues holding its recent gains while hovering just around the $90 area increases the probability that a decisive breakout could occur. And once such breakout begins, the next significant resistance line or level, well, it considers higher. It could be considerably higher. Can you imagine if it busts above 120 again? It could be another ground floor. Now, technical analysis study long-term targets and charts have pointed towards the low hundreds and as the next structural region where the market may encounter resistance. Beyond that, even higher price targets begin to enter discussion. Another technical indicator that traders frequently monitor is the Relative Strength Index, commonly known as the RSI. This indicator measures momentum by comparing the speed and magnitude of recent price changes. When the RSI climbs above 70, it typically suggests that a market may be overbought and vulnerable for a correction. When it falls below 30, it suggests that markets may be oversold. Currently, the RSI silver hits nearly mid-50s, which is considered a healthy and balanced level during the ongoing rally. An RSI reading in that region indicates the momentum has cooled slightly from the initial surge, but remains firmly supportive of further upside. It means the market has suggested recent gains without reversing direction. In other words, silver has room to continue rising before the technical indicators, begin flashing warning signs of exhaustion. Momentum traders also monitor another tool known as the moving average, divergence indicators, commonly abbreviated as the MACD. This indicator compares two market averages in order to identify shifts in momentum. At that moment, the MACD still appears slightly negative on the surface, but the gap between the lines has become narrowing. In technical analysis, this type of narrowing often signals that bearish momentum is fading. When the gap eventually flips and the faster moving line crosses above the slower single line, it creates what traders call a bullish crossover. Because a significant portion of futures trading volume is driven by automated systems, the crossover can trigger a wave of algorithmic buying. The resulting influx of orders may push the market through key resistance levels with surprising speed. All of these technical signals become far more meaningful when they align with the fundamental history and story driving demand for the silver, which is unlike the situation decades ago when the speculative activity dominated the market. And today's silver demand is deeply rooted in real economic activity. Industrial consumption has expanded dramatically. Solar energy production alone now consumes enormous quantities of silver because the metal is essential. The rapid growth of artificial intelligence infrastructure is also contributing to the increased demand. Data centers powering advanced computer systems requiring massive amounts of electronic hardware. Silver plays a critical role in higher performance circuits, connectors, and specialized components used in these systems. As technology companies race to build larger computers facilities capable of handling artificial intelligence workload, their need for silver continues to rise. At the same time, global inventories have been shrinking. Physical supplies stored in key trading hubs have declined as industrial demand steadily absorbs available metal. Some reports indicate that inventories in the major Asian markets have fallen to levels that would have seemed unthinkable a few years ago. When inventories decline while demand continues expanding, the imbalance eventually forces prices higher, unlike many other commodities. Silver mining cannot rapidly increase production when prices rise. Developing a new mining operation can take many years, sometimes 10 to 15 years. Permitting, constructions, infrastructure development, even if the prices suddenly spike tomorrow, the physical supply response may take nearly a decade to fully materialize. That delay means that the market must rely on price adjustments to balance supply and demand. When supply becomes constrained, price rise until enough demand is reduced to restore equilibrium. But in the case of silver, much of the demand is tied to critical critical industries such as renewable energy and advanced electronics. These industries cannot simply eliminate their need for silver without replacing entire technology system. As a result, the demand destruction becomes extremely difficult. All of these factors combine to create a situation where the market may eventually be forced to reprice silver significantly higher in order to ration limited supplies. And I believe it should have been done multiple years ago. We've been in a deficit for 6 or 7 years now. Every year, 500 to a million ounces of silver in a deficit. And when you combine that structural demand with a geopolitical uncertainty and monetary pressures currently unfolding across the world economy, the stage becomes set for potentially dramatic price movement in the years ahead. To understand why the moment could become so important, it helps to step back and look at the broader relationship between monetary systems and hard assets. Throughout thousands of years of human economics history, gold and silver have repeatedly emerged as the ultimate stores of value whenever confidence in paper currencies begin to weaken. Empires have risen and fallen. Monetary systems have been created, abandoned, and replaced. Yet precious metals have always remained constant reference points for value across civilizations. Now, when markets begin shifting capital into metals at an accelerated pace, it often reflects a deeper loss of confidence in the financial structures that normally dominate investment portfolios. Today, many of those structures are facing pressures that did not exist during previous decades. Global debt levels have expanded to historical extremes. Governments across the world are running enormous deficits. Central banks are trapped between competing priorities. If interest rates remain high, economic growth may slow dramatically. If rates are lower aggressively, inflationary pressures could return. That dilemma creates a fragile balance that markets must navigate carefully. Investors understand the stability of currency ultimately depend on confidence in the institution margin managing them. Whenever that confidence begins to erode, capital tends to migrate towards assets that cannot be printed or created through monetary policy decisions. Gold has traditionally been the primary beneficiary of those migration, but silver often flows with even greater volatility because its market is smaller and more sensitive to shifts in demand. The unusual relationship between silver and oil that recently emerged reflects this dynamic in a powerful way. Oil represents the backbone of modern industrial activity. It fuels transportation networks, manufacturing systems, agricultural production, and monetary operations. Under normal economic conditions, energy tends to command a premium relative to precious metals because societies require enormous quantities of fuel to sustain economic growth. When silver surpasses oil in relative value, it signals that something fundamental in market psychology has changed. Investors begin valuing monetary stability more highly than industrial expansion. That shift does not occur frequently, which is why the signal has appeared so rarely in modern history. The previous time it occurred, the global financial system was under intense pressure from inflation, geopolitical tension, and a widespread loss of confidence in government policies. Today, many of those pressures are reappearing, although in different forms. Government's debt level has expanded dramatically compared with early decades. The scale of deficit spending has increased across the multiple economies. Central banks that once attempted to normalize monetary policy have found themselves repeatedly forced to intervene during economic disruption. Each intervention often involves creating additional liquidity within the financial system. Over time, repeated interventions can gradually weaken confidence in the long term purchasing power of currencies. Investors may begin searching for assets capable of preserving value regardless of policy decisions made by governments or central banks. Precious metals historically serve the role because their supply cannot be expanded quickly or easily. At the same time, geopolitical tensions have increased across several regions of the world. Strategic competition between major powers has intensified. Military conflicts and economic sanctions have become more common tool within the international relationship. Whenever global stability appears uncertain, financial markets often experience sharp movements as investors reassess their risks. Recent events involving military action and diplomatic tensions have demonstrated how quickly commodities prices can reflect the political developments. Oil markets, in particular, responded dramatically to announcements and statements made by the political leaders. Within a very short period of time, price moved by an extraordinary percentage simply because traders interpret new information about the political direction of a conflict. That type of reaction illustrates how sensitive modern markets have become to geopolitical signals. But it also raises an important question. If a single statement can move one of the most important commodities in the world by such a large amount, what might happen if a genuine supply shortage appears in another critical market? The silver market is considerably smaller than the global oil market, which means price movement can become even more dramatic when supply and demand fall out of balance. Current data suggests that the global silver demand already exceeds annual production by a significant margin. Now, each year, the world consumes hundreds of millions of ounces more silver than mines produce. Now, that deficit has been sustained by drawing down existing inventories stored in various financial and industrial reserves. However, inventories cannot decline forever. Eventually, those reserves approach levels where the market must adjust through price. If industrial users begin competing more aggressively for physical metal, the price required to secure available supply could rise rapidly, unlike many other commodities. Silver mining cannot expand output quickly enough to relieve sudden shortages. Not like oil, where you can just increase production. New projects require years of development before they can deliver meaningful production. Meanwhile, several industries that rely heavily on silver are growing rapidly. Renewable energy technologies continue expanding across the globe. Advanced computing infrastructures supporting artificial intelligence required vast amounts of electronic components. Electric vehicles, medical equipment, telecommunication systems, 5G, all incorporate silver within their design because of its exceptional connectivity and reliability. These technological trends suggest that silver demand may continue increasing even if the economic conditions fluctuate. Not to mention the amount of silver needed in the military for multiple things that we've just talked about, electronic wise, also armament. When demand grows structurally while supply remains constrained, markets often experience extended periods of price appreciation. Another important factor influencing precious metal markets is the behavior of central banks. In recent years, many central banks around the world have been increasing their gold reserves at a pace rarely seen in modern financial history. The same thing goes for silver. Governments that once relied heavily on foreign currency reserves have begun diversifying its physical assets. Although central banks primarily accumulate gold rather than silver, their actions reflect a broader shift in attitudes towards monetary security. When institutions responsible for managing national reserves begin emphasizing hard assets, physical investors often follow the same strategy. Financial markets tend to move in cycles influenced by psychology as well as fundamentals. Prior to the confidence encouraged risks taking and investments in growth oriented assets. Periods of uncertainty encourage defensive positioning and wealth preservation. The environment appears to be gradually shifting towards the latter phase when investors observe record debt levels. Volatile geopolitical, unprecedented monetary policies occurring simultaneously may begin reconsidering how they allocate capital. Precious metals become attractive, not necessarily because they generate income, but because they provide protection against systematic risk. That protection function becomes especially relevant when markets begin to sending signals that rarely appear. The moment when 1 ounce of silver trades above the value of an entire barrel of oil represents one of those signals. It condenses an enormous amount of economic information into a simple comparison. It tells you that investors are increasingly concerned about preserving purchasing power. It suggests that confidence in existing monetary structures may be weakening, and it highlights the growing importance of tangible assets in an era where financial uncertainty appears to be expanding. Let me know what you think, and please leave a comment in the comment section. I'll leave a comment for you. Please subscribe. I'm building a show, and I do need your help and your support. Try to have a great rest of your day. God bless you and your family and America.